What's up, YouTube fam? It's Sean Uyehara with Geneva Financial, and I know it's been a while since I've dropped a video. I'll give you a quick update for all my loyal subscribers. I've been a little MIA because my father passed away a couple of months ago, so I've been spending time with my mom and my family, and I haven't had time with just traveling, trying to shoot content. So finally got some time. We're going to start getting some content back out to you guys to help you get back on track with your real estate and mortgage needs. For all of you that are new to the channel, I'm an area manager with Geneva Financial. We're licensed across the country. I personally cover about 22 states. You can hit the description below for states we're licensed in. And if you have questions or need a second opinion on your home financing, you can always shoot me an email. Or if you need to get pre-approved, my team can certainly help you out, and we can get you into your new home in no time. Now, today's video is catered more towards those of you that already own a home, or maybe you're thinking about buying and you want to know, how do you pay your house off faster? But in this video, I'm going to show you how you can pay your house off in 7 years faster than your current 30-year mortgage, which is the most typical mortgage that people are faced with today, and how it can save you hundreds of thousands of dollars on your mortgage. All right, so I'm gonna put together a quick little scenario here, and we're just gonna run through this really quick. And this is on bankrate.com's website. So you could literally just go there yourself. And if you already own a house, you can go through this calculator and try to figure it out and see how fast you could pay off your property. But we're gonna do this, like I said, in 7 years and see what it does. So I'm gonna point out a couple of things that we've already input into the system. So we are gonna assume that we've been in this house for 2 years. So you have 28 years left on your mortgage. The original term was 30 years. Most loan officers are putting their clients into 30-year mortgages when rates were really low. Many clients opted for 15 or sometimes even 10-year loans. But typically, the shorter the loan term, the better the interest rate can be. But with where interest rates are today, you might not want to take a shorter term, because the shorter term will mean a higher monthly payment. So we're going to assume that this was a 30-year mortgage. The original loan amount was $400,000. Again, you can adjust that based on what your loan amount was when you purchased. So we're assuming we're going to add another $310 per month to this loan payment at a 7% interest rate. This would shorten our loan term by 7 years. So when we look at the payoff, you will see that another $310 a month. The normal principal and interest payment was $26.61. The accelerated payment will be $29.71, and you're saving $146,000 in interest. This is why when you look at the strategy on how you finance your home, it becomes so important, because if you're in the wrong loan, you're in the wrong type of structure as far as how your loan was financed up front. Did you pay points? Did you not pay points? All of these things matter on the back end, and it could literally cost you money. Now, even if you didn't pay points in this scenario, at 7%, some people are like, oh my God, that's such a high interest rate. It's a horrible deal. Well, look, if you paid the house off in 7 years less, you just saved yourself $146,000 in interest. Now, the beauty of paying your house off faster is that you're also accelerating the equity that you build up in your property. This is where you can get a lot more creative on the back end, because you can tap into home equity lines of credit where you can use that equity to go buy another rental property. Or if you're just maybe trying to plan for retirement and you're like, hey, I want to have a house paid off by the time I'm, call it maybe 50 years old or 60 years old. You can figure out what that actual number needs to be to accomplish the goal. This is where I love mortgage planning and strategy with our clients, because we can do little tweaks like this to their current existing mortgage to help them accomplish the goals that they're looking for. And I guarantee you, for most people, if they were to look at a mortgage and to think that $310 would have such a massive impact to save $146,000, most people are completely unaware of that. But this is where having a mortgage refresh or mortgage checkup annually is a really good thing to do, because this can be the type of tool to either get you to financial freedom, help you either build wealth faster, or sometimes right now what we're seeing a lot is helping clients get more cash flow positive, because credit card debt is at an all-time high. There was an article the other day that I think as a country we hit over $1 trillion worth of credit card debt. So if you own a home, this may be a good way to restructure your debt servicing, increase your cash flow, and get you back on track. So again, don't get caught up so much on where interest rates are. Don't get caught up so much with what the media is telling you. Do things like this with your loan officer, or if you don't have one, you can definitely reach out to myself and my team. I'm happy to do an analysis like this for you and figure out whatever your goals are. Like I said, the most common things we're always seeing is people want to get to retirement quicker, or they want to be able to purchase another rental property, purchase a vacation home sometimes for the family, or the fact that, again, in, you just got all this debt. You need to just get yourself away from all the debt, maybe away from bankruptcy, and get yourself a fresh new start. So there's a lot of pros, a lot of benefits to being a homeowner. You can use your equity, but be smart. Don't use your house like a piggy bank, because I've seen this time and time again where homeowners will refinance, pay off their debt, rack up a bunch of credit cards, 5 years later, refinance, pay off all their debt, and do this over and over and over to where they literally use all the home equity that's in their property and then they have nothing left. So be smart about it. Look at some options, look at some strategies. But if this is you, adding $310 a month to your monthly payment, you could pay your house off in 7 years faster, saving you $146,000 in interest. How cool is that? Share this with a friend who owns a home that maybe want to pay their house off faster. And if you need an analysis, shoot me an email. I'll be happy to chat with you. We'll see you then.